While the basics of real estate agreements and sales are covered in other presentations, this presentation will focus on common clauses in real estate contracts. We will discuss the natures of the clauses and their purposes. In the text below this video, we are linking to a sample contract with these clauses and more included, so please feel free to review this for context. This presentation will cover 3 of the most important real estate contract provisions, and another presentation will cover several more. The first clause is earnest money and forfeiture by breach. Real estate contracts call for a specified amount to be paid at the time of the signing of the agreement, with the remaining due at closing. This amount, known as earnest money, is also sometimes referred to as a down payment, though it shouldn't be confused with the down payment that mortgagors pay in addition to the amount of their mortgage loan to complete the payment. The amount of the earnest money can vary widely, and while the National Association of Realtors says to expect a down payment of 1 to 2% of the purchase price, many contracts call for earnest money of 10% or more. The earnest money is typically held by an escrow agent, such as one of the attorneys handling the transaction, from the time that the contract is executed through the closing, at which time the earnest money is given to the seller as part of the purchase price. Aside from the fact that this money cannot be used by either party between contract and closing, the amount of the earnest money is critical, because many real estate contracts call for the earnest money to be forfeited if the buyer inexcusably fails to complete the purchase. The earnest money, then, serves not only as an indication that the buyer is serious, but it also protects the seller. In reliance of the contract, the seller typically takes the property off the market and stops trying to sell it elsewhere. If the buyer breaches the agreement, precisely measuring the damage caused to the seller because of this reliance is all but impossible. Therefore, the earnest money creates at least some level of certainty by providing the seller with compensation if the buyer breaches. Conversely, it also provides the buyer with cost certainty, as the buyer may later decide that forfeiting the down payment is an acceptable cost to get out of the transaction. For example, let's say the buyer pays $10,000 in earnest money on a $300,000 house. The buyer may later find a comparable house for $275,000. It makes economic sense in such a case for the purchaser to simply breach the initial contract, forfeiting the $10,000 in earnest money, and purchase the second house. This maneuver is sometimes known as an efficient breach, and it is not discouraged under contract law. Next, we'll look at marketable title. The responsibility to provide marketable title is a fundamental duty of the seller in any real estate transaction. While the term marketable can be defined using case law or other precedent, the contract can also define marketable with respect to its transaction. A typical provision defines marketable title as title that a title insurance company is willing to underwrite and insure. If the title insurance company is willing, after an appropriate title search, to insure title, which means that it will compensate the purchaser for any damages caused by defects in the title, which usually means mortgages or liens that were previously enforced and never satisfied, then the title is self-evidently marketable. Next, we'll look at mortgage contingency clauses. A mortgage contingency clause makes the contract conditional on the purchaser securing a mortgage, as described in the agreement, within a specified time after the contract's execution. Though purchasers can obtain pre-approval letters that indicate that they're likely qualified for the mortgage they need, most banks will not give final approval to a mortgage application unless the potential borrower can produce a signed sales contract. Moreover, the approval process often requires appraisals, inspections, title searches, and various other steps that would be too cumbersome and expensive without the certainty of a signed contract. Though purchasers normally expect, in good faith, that they'll be able to secure the mortgages they need, they naturally don't want to lose their down payments should the mortgage applications fail, for whatever reason. The mortgage contingency clause may state, for example, that unless the purchaser secures a mortgage for 80% of the purchase price within 45 days after the contract is signed, either party can terminate the agreement, in which case the purchaser gets his earnest money back. The provision typically requires the purchaser to make a good faith attempt to comply with all requirements necessary to secure mortgage approval. This clause allows the purchaser to avoid the risk of losing his down payment if his mortgage application fails through no fault of his own. The time frame limitation also allows the seller to cut her losses and move on to the next potential purchaser if she sees that the purchaser is having trouble obtaining a mortgage. Naturally, sellers prefer contracts without mortgage contingency clauses, sometimes referred to as cash transactions, because they eliminate this uncertainty. In fact, sellers are often willing to accept slightly lower offers if they do not require contractual mortgage contingencies. Our next video, a continuation of this presentation, covers the basics of 5 additional common real estate contracts clauses.